Alright guys, let's solve another question on profit statement. So in this question you guys can see they're saying Naferton Limited manufactures a single product. The variable cost structure has been given for and it has not changed for several years. So you have your selling price per unit, direct material per unit is given, labor per unit, direct production expense, and your selling expenses also given. Alright, so the normal production level, normal means that's the budgeted production level is 180,000 units. They expect to make this much. Fixed production overhead or fixed manufacturing cost is 108,000 and fixed selling cost and admin cost is 75,000. Alright, so if I were to first find the marginal cost of a unit, remember marginal cost of a unit, if I calculate that first, that's equal to direct material, direct labor, and direct production expense in this case. Alright, so there are only three variable manufacturing cost, that's this. Selling is a non-manufacturing cost, so marginal cost of a unit should be 3 plus 8 plus 3. So marginal cost of a unit is 14 per unit. So according to marginal costing, the cost of manufacturing a unit is 14. Now if I were to calculate the absorption cost of a unit, alright, so if I were to calculate absorption cost, what would be added? Direct material, direct labor, direct production expense, but it would also include fixed production overhead per unit as well. So 3, 8 and 3 remains there. Fixed production overheads are 108,000, but we need to trace it on a per unit basis. So the expected production level is 180. So I can say that will be 108,000 divided by 180,000 units. Alright, so if we calculate this, we get this to be 14.6. So fixed production overhead should be 0.6. So if you divide 108 by 180, you should get 0.6. So the absorption cost will be 14.6. So marginal costing says that the cost of making a unit in this case will be 14. Absorption costing says that the cost of making a unit should be 14.6. The additional cost is your fixed production overhead. Alright, let's look at the next part now. Okay, so if you guys see, they've also given us the units as well, the number of units produced and sold for each year, 93 and 94, opening inventory units, production units, sales units, closing inventory units. Alright, so they've already calculated the units for us. Remember, the equation for units is the same. That was opening inventory units plus production units minus sales should give you closing inventory units. Alright, but again, these are your units, not the value. Value we will have to calculate it. Alright, and they're saying that you have to assume that fixed cost has remained constant over the years. Alright, let's move to the first part. Alright, so they're asking us to first draw the marginal income statement. So I'll do it for 93 and also absorption. You guys can do 94 yourself. Alright, so let's start filling in the numbers. Sales. So we just saw the number of units sold are 210,000 units are sold and the selling price per unit was $20. That becomes 4,200,000 or 4.2 million is your sales. Alright, so you get your sales. Alright, so now let's find the variable cost of sales. First is opening inventory. Now we know that the number of units in opening inventory is 40,000. And according to marginal costing, we just calculated the cost of a unit is $14. So to find opening inventory, we'll do 40,000 into 14. That should give you 560,000 is your opening inventory. Okay, next you get your direct material. That was 3 per unit and we have made 190,000 units. You get your direct material cost. The total direct material spending is $570,000. You have your direct labor. This was 8 per unit times 190,000. You get your direct labor over here. That should be 1520000. That's your direct labor. Then you have direct production expenses. So there are no variable production in this question. That's also 3 per unit times 190,000. That's your direct production expense. You should also get 570,000 for that. All right, now we'll subtract the unsold goods or your closing inventory because that cost is not part of your cost of sales. So we had 20,000 units in closing inventory, and we will multiply that again by the marginal cost, which is 14. So your closing inventory turns out to be 280,000 over here. All right, so we've calculated all costs. Now guys, you're supposed to calculate the variable cost of sales, add up all your costs, subtract closing inventory. So you guys should get 2940000. That's the cost of goods sold. So subtract sales by cost of goods sold, you'll get your gross contribution to be 1260,000. All right, that's your gross contribution. Now again, remember, why is it gross? Because all variable costs have not been subtracted. There is one variable cost left, that's your variable selling. In this case, you guys can see that was given as direct selling expense. It was 1 per unit. I will multiply it not by the units produced but the units sold. That's 210,000. So I'll get my direct selling or variable selling to be 210,000. So that gives me a contribution of 1,050,000. That's my contribution, the money left after paying off all your variable cost. Now I'll subtract all my fixed costs. So in this question there were two fixed costs again. One was fixed production overhead, that was 108,000. I'm going to write that as it is. Then there was fixed selling and admin, that was 75,000. So that means your fixed cost add up to be 183,000 over here.
Quick pause. If you're finding value in this explanation, there's so much more to discover. At Alt Academy, we break down every A-level concept with the same level of clarity. Now, let's continue.
So you should get your marginal profit to be 867,000. That's your marginal profit. All right, so I've drawn the marginal income statement for 1993. What I'm going to do next is I'm going to draw the absorption income statement again for 93 so that we can compare the two statements over here. Okay, now let's draw the absorption income statement for the same year. Again, guys, remember the idea is this, that once you've done all the working in marginal, you just pretty much have to write down all the figures and you'll just have to rearrange the numbers. But the workings have been done. So for example, when I have to write sales, I don't have to calculate it. I know my sales is 4200,000. I've already calculated that for marginal. Opening inventory will change. Obviously, you have 40,000 units, but absorption cost of a unit was 14.6. All right, it wasn't 14. That was for marginal. Absorption cost of a unit is 14.6. So that should be 584,000. Direct material, just write that down again, 570,000. No need to calculate it. Direct labor, 20,000. Your direct production expense stays the same, 570,000. I'm going to write that value again. Okay, now what changes is that marginal costing did not include the fixed manufacturing cost as part of your manufacturing cost because they only considered variable cost to be relevant. Absorption believes in total costing, so they will also include fixed manufacturing overhead. Now, how do you calculate this number? Remember, let me take you guys back for a minute. So remember guys, under absorption costing, we also included fixed production overhead per unit. So I calculated this to be 108,000 divided by 180,000. This was 0.6 per unit. So absorption costing, we said that the fixed production overhead per unit should be 0.6. So what I can say over here is that the fixed production overhead per unit was 0.6, and this year we made 190,000 units. All right, that's the number of units produced. So if you calculate this, you should get 114,000. That's your fixed manufacturing overhead or fixed production overhead. So I can write this down, 114,000. This should also be part of your cost of sales. All right, for the same logic for closing inventory, we're going to do 20,000 times 14.6. I should get that to be 292,000. That's your closing inventory. Okay, now before that, I want you guys to now look at one new thing over here. Your fixed manufacturing cost is 114,000. Now, your fixed production overhead was 108. Now, what we're saying is that by increasing output, your fixed cost has changed. That actually contradicts the definition of a fixed cost. Remember, variable cost is the cost that moves with the output level. Fixed cost does not move with the output level. So, fixed cost has to stay constant regardless of the level of output. So, over here, we've overcharged our fixed cost, and the reason is this, that we expected to produce 180,000, but we ended up producing 190,000 units, so we made more units. Now we'll have to adjust this. So if you have overproduced, if your actual production is greater than your normal production, you would have overcharged your fixed cost or you would have over absorbed it. But if your actual production was less than the normal one, all right, in that case you would have undercharged your fixed cost. So I will call that to be under absorbed. All right, now how do I treat this? I've written my fixed cost to be 114. It should still be 108. So I have to reduce my fixed cost by 6,000. So I will write less over absorbed 6,000. If I had undercharged it, I would have to add it to my fixed cost. So I would have said add under absorbed to the cost. All right. So I'm making all the adjustments to my cost. In this case, obviously there is no under absorbed. There's only over absorbed because we have overcharged our fixed cost by 6,000. So I need to subtract that. So you should get your cost of sales to be 3060,000. If you add up all the costs and subtract closing inventory and over absorb, remember you have to reduce your fixed cost by 6,000. You will get your gross profit, not contribution, gross profit, since we've taken total cost to be 1140,000. All right, now the last thing, you have to subtract all your non-manufacturing expenses. Those expenses that were there in marginal but were non-manufacturing. So that's variable selling and that's fixed selling. Right, variable selling was 210,000. You guys can refer to your marginal income statement, and fixed selling was 75,000. That means your non-manufacturing expenses and losses are 285,000. And you should get your absorption profit to be 855,000 over here. All right, so now you guys can see that under absorption there was one new item over here. Since your budgeted production and actual production were different, something that we also saw in absorption costing, I ended up charging fixed cost to be higher than what it actually was. So I had to reduce it, calling it over absorbed. Similarly, if I had undercharged my fixed cost, I would have to add it to my cost over here. And you arrive at your absorption profit. I would ask you guys to solve 94 by yourselves, and I will also do the reconciliation part over here. Okay, so as the last step, let's reconcile our profits for 93. Remember, the marginal profit was 867. Now, as I did earlier, we need to add the difference in closing inventory. So we should compare the absorption closing inventory was 292, whereas the marginal closing inventory was 280. And you guys can also verify this from your statement. Absorption was 20,000 units into 14.6, and marginal was 20,000 units at 14. So that difference is 12,000. So I will add this difference of 12,000 over here. Remember, higher the closing inventory, higher the profit. Then less difference in opening inventory. So absorption opening inventory was 584,000. That was 40,000 units at 14.6. And marginal opening inventory was 40,000 units at 14. That was 560,000. Refer to your income statement, guys. And this difference is 24,000. So higher the opening inventory, lower the profit. It has an inverse relationship. So marginal profit is 867. Closing inventory difference increases your profit by 12, but opening inventory difference should decrease your profit by 24. So if you guys see, you will arrive at 855,000, which is my absorption profit for 93. So what I can say is the difference between marginal profit and absorption profit was due to 12,000 in closing inventory and 24,000 difference in opening inventory. Alright, so you guys should now attempt the 94 statements and reconcile the profits to see whether you arrive at the correct answer.
Our complete A-levels accounting course is waiting for you on our website. In addition to accounting, you can also find business, economics, maths, and 4 other full A-level offerings. So thousands of students who've already unlocked their potential. Visit All to Get Me right now.